All right, I think we're live. Hey everyone. Okay, I see the chat's starting to get popping. Okay. Let me see. I want to make sure that I have everything set up. So we're also live on YouTube as well. Hi, okay. Isabella, Rod, Jesse. I see a couple people there. Mark. Hi, everybody. All right, we're going to get started right now. All right, guys. I think you'll be able to hear me. Okay, I see somebody said I'm all about making money. Let's get it. Okay, let's get it. Let's get started. So basically, I want to start off first, especially since we have a lot of people talking. I want to get to know you. I want to get to know exactly why you're here. Why do you want to learn how to talk options? Of course, it's to make market money, to change something in your life. But let me just find out who's in the building. So I see Jerry is from Nashville, Tennessee. Okay. Just drop in there and let me know, what are you trying to make? What is your goal as far as learning how to trade the market, especially with options? What are your goals? Okay, so I see someone said to make good income. Okay, so you want to make a side of income. Okay. What are your careers? So, all right, I see Henry said to replace my job. All right, what do you do? Let me get an idea of where you are right now so we can see who's in the building. And also let me put a thumbs up if you downloaded Thinkorswim, because I will be using that platform so that you can see a little bit of what it looks like. Okay, so I see someone said I'm a VP of sales in IT. Okay, technical recruiter, professional trader. Okay, I want to build. Real estate. Okay, currently not working. Engineer, sales. Okay, awesome. Let me see if I can share my screen now. Okay, IT project manager, massage therapist. Okay, so we have a lot of different people in the building. We have some people who are corporate, those who want to replace their job completely. I see one person said that my uncle told me options trading and he said that it was better. Yeah, definitely a smart grandpa there. Currently a correctional officer looking to leave law enforcement. Okay, so you're looking to then get into the entrepreneurial state. A lot of people, I will say, you can use options as a way to do that, because now you can use a smaller amount of money to still generate income, as if you were trading stocks, as if you were trading futures, but now you're using less. Okay, this person said, I want to learn the stock market to make over 1,000 to 2,000. Got it. Trying to gain more knowledge. Single mom, works part-time, homeschooling. Okay, so you want to learn how to make some money while staying at home and taking care of your kids. Got it. My goal is to be a professional trader and to hurt Wall Street. I know that's right. All right. Okay. So we have a lot of different people in the building, but it sounds like the commonicity here is that you want to be able to make money on the go. One of the reasons why I started learning how to trade was that very reason, to be nomadic, to not be stuck in the corporate structure. And if you lose your job, especially with what's happening right now, you just have to have multiple sources of income to really get by. And even if you have a good paying job, maybe you want something that allows you to be more nomadic in life, where you're not always stuck in the corporate structure trying to, answer to other people. So if that be the case, yeah, you want to make that laptop money. That's the reason why I started in college. So a lot of the information that I learned from options trading, this came from actual professional traders that are in the field right now. I did take my Series 7. And so one thing that you will probably hear from a lot of financial advisors is that majority of that test is on options trading. So you really have to learn the basis of it to even pass. And so options trading for me, what I started realizing was the reason why a lot of retail traders are not in that field is because it takes a little time to understand. And most of the people who's teaching it, like, let's just be honest, they're like 50 and older. You're not going to find many people on YouTube. You probably already searched. You're not going to find many that are talking about options trading, especially amongst the millennial age group. And so that was one of the reasons why I wanted to start this page. Not only that, but there was a lot of scams that was going on in Forex. You can just let me know in the comments section if you are an ex-Forex trader, or if you're a Forex trader right now and you're trying to step over. One thing that I learned, though, with Forex, okay, we have one ex-Forex trader there, is that you're dealing with basically a 50-50 market where you always have to be right on your direction. But the thing about options trading is that what you can do is you can trade options and not be right in your direction and still make profit. And so when you have the ability to trade directional and trade non-directional, what it gives you is an edge in the market. And the way that you're able to do that is by trading spreads. Not only that, but there's another part of options called short options, which is something that you definitely can't do in stocks, futures, or Forex nakedly. Is with short options, what you can do is you can collect money from the market and trade it. So let's say, for example, let me see if I can share my screen with you now. All right, here we go. Someone just comment so I can make sure that you can see what I'm seeing. This is Thinkorswim here. Okay, you can see it. I just see a circle. How about now? Can you see it? You should see a full Thinkorswim chart here. I'm gonna pull out one. Okay, so I'm showing the euro. Okay, I'm back. Just wanted to see if I had to refresh it. Are you seeing it now? This is a euro. Okay, perfect. One person said yes, one person, all right. Cool. Let me pop in there right now then. So what I want to show you, just to get started with like some of the futures that you can trade, I'll start off first with the one that I talk about the most, and then we'll talk about God. Actually, let's start off with God first, which would stand for gold, the metals. So one of the things I wanted to mention to you guys, and that's the reason why we simplified it to trade God, is because no matter what your financial situation is, God has your back with options trading. God for gold, oil for the O, D for currencies. That's not anything religious. That's just the truth right there. God has your back. The D is for dollars, the euro, currencies, all of those. And so what I'm showing you right here is gold futures. And you can see that this is what we've seen. Now, if you're trying to figure out what exactly you're looking at, this is a chart on Thinkorswim. And these right here are what you call standard deviation levels. And so this is if anyone in there is familiar with statistics. Okay, you can hear the sound. Okay, cool. Somebody said, I love it. God, exactly. I love it too, especially because it makes me money. So this right here is the first standard deviation, and this is the second standard deviation. And this is a daily chart of gold. So this is basically showing you the overall trend of gold for the last year, from January 21st all the way to January January of this year, from 2019 to 2020. This is what we are seeing with gold. And basically what I want to show you here is you can see that there's a very simple pattern. It's staying between this first standard deviation. Now, this is on a daily chart. Bringing it to a 4-hour chart, and I'm going to get to the fundamentals next, but this is what we've seen on a 4-hour chart. So again, this is a lot of movement that we've seen with gold. Now, with options trading, what I was mentioning is you can go over to this trade tab, and this is what we will talk about a little bit later, called the options chain. But in this chain, what you are able to do is, again, now we are not only talking about buying out, right? We're also talking about selling. And selling is you collecting premium. You basically saying, I'm going to take $500 from the market on my direction and say that I believe that the gold in this case is going to go up or it's going to go down. That's what short options is. Someone said, what standard deviations do you use? So the standard deviations that are listed, okay, one person said, how do you get to that standard deviation? I'll show you that in a moment. Those standard deviations are basically based off of the probability curve. So you have one standard deviation that equals 68, then you have one that's 95, and then you have one that's 99. Now, usually when you're talking about standard deviations in trading, they stay between that 1 and 2nd standard deviation. Now, the thing about standard deviations, what's so sexy about it? Why is it so powerful? The reason why I wanted to show you that screen is because one thing that you'll see, even if I were to show you maybe 9 different instruments. So if I was to go to this chart here and show you about 9 different instruments, take a look at these 6 at the top. What do you see? It all stays between these standard deviations. It all stays between the first. Now this is corn, and this is we saw a little bit of it went past the 2nd standard deviation here. But with most of these charts, it stays between the 1st to the 2nd standard deviation. That's something powerful to use on the technical side. But really what I started talking about really heavily on my page was not even only looking at the technicals, but putting this together with what you will see with the fundamentals. And I don't know if a lot of you guys were able to see this workbook that we had. So we had a workbook that I sent out to a couple of people, and it was basically on seasonality. How can you start trading seasonality and learning how to trade, just learning what are the different seasons and what's happening around you. So if you were trading natural gas, if you're trading crude oil, you know that during this time, because it was getting cold, especially in November and December, we saw prices go up. And this is very easy for a lot of beginners to understand. So I'm going to show it to you right here. This is what we sent out for seasonality. Make sure you can see that. Okay. Okay, so this is what you should be looking at right now. Give me a thumbs up so I know that you're seeing it. Okay, perfect. Because I see someone said, what if you've never traded? Okay, so you will get this. This is a workbook that we put together on diving into futures options. Now that's talking about the risk. This is what I was telling you about Forex. 99.6% of retail traders in Forex are not able to back up 4 back-to-back profitable quarters. They're not able to be profitable in 4 back-to-back quarters. This was one of our main things that we talked about on our YouTube page. And it's because this statistic, by the way, this came from brokersnotes.com. And they did some research. This was research that was done by, I believe, an Englishman who's in finances. And this was some of the information that they found. Now, why would I actually believe this? Because again, with Forex, you always have to be directionally right. Well, if you're not able to hedge with short options and you're not able to, back up your trades, well, then if there's no risk management behind it, I can see why a lot of traders end up not being profitable. And that's exactly what options trading gives you. So with options trading, with seasonality, what you can do now is you can get paid to trade, and you can also trade just based off of seasonality. I'm going to give you a link to this, but what I want to get down to is the part where we talked about the seasonal trends. Okay, so why seasonality? When you're looking at underlyings, like say, for example, I think Jamila said that you're a beginner's trader. Okay, so let me give you some trades that you would be able to look at and understand from a seasonal standpoint. So with corn, the seasonal high and lows, there's a seasonal high that usually happens in April and June, and there's a seasonal low that happens in August and October. I can also tell you there's another seasonal high that happens usually right around December time, which is what I'm going to show you happened with corn. Why does this happen? Well, after the post-harvest rally, this is all based on what's happening with farmers and the supply and demand. You have this little seesaw that you deal with futures options, where you have the supply and demand that really helps you understand where price is going to go. So with the spring rally, which begins in March, deliveries and focus on new crop starts to happen with the planting and the weather. Now that seasonal peak usually happens around June. So you're looking at this and you're like, okay, but does this actually happen? Like, how do I know this happens year after year after year? Let me show you better than I can tell you. Yes, you will be able to replay this. You said that we get a copy of this visual. Yes, I'll send you a copy of this. I emailed this out to a couple of people as a special giveaway, which is what we're trying to do here. But yes, everyone who's here, if you just send me, I believe you'll be able to do a private chat and put your email address, then I'll be able to send this to you. So let me show you corn. Now, I just mentioned to you the fact that with corn, there's usually a seasonal high when right around April and May, because this is when the season starts to kick off, and right around November and December. So if I were to show you the seasonal chart, this is exactly what we saw with the prices of corn in 2019. Right around April and May. Guess what happened during this time? Especially if you live in the Midwest, you know exactly what happened. The field started to flood. And so prices went through the roof because a lot of farmers lost their crops. So that happened right between April all the way to May. But here's another thing that I want you to take into consideration. When you're looking at this trend, this right here is where you will deal with all of the different charts. So you can see I can change this to a minute chart, 5-minute chart, all the way up to like a weekly chart. And you can customize this as well. But we're just looking at the daily chart. This is what we saw happen right around August time. And this was because why? Well, now there's too much of the crop, because usually right around summertime, you'll see prices go down. Why? Again, it's based off of supply and demand. If there's more supply, there's less demand, prices are going to drop. If there's less supply and more demand, prices are going to go up. And that's exactly what you can see with a lot of futures. Now, why would you like to trade futures over trading stocks all the time? For this very reason, you have higher predictability. I have high predictability trends, not only with seasonality, but then also using technicals like this, which gives you basically different entries that you would be able to look at. And the reason why is because you see a lot of these underlyings, they follow these standard deviations. So let me show you this. Wheat is another good example. Oh, this one's so beautiful. And the reason why is because look at this. It literally bounces off of these standard deviation levels. Now, if you want any information on, okay, why would you even trust standard deviation levels? Think of it as a normal probability curve. Again, you probably remember this from statistics. That first standard deviation is saying 68% of the time, prices are going to stay between here. That's a high percentage. That's a really high percentage. Well, in two standard deviations, I know that price is going to stay within that range 95% of the time. Look at what happened with wheat right around that's July time. It bounced off of that standard deviation and went all the way down to about a -1. Now, I'm not only getting in just because it bounced off, but I'm backing it up with the fundamentals that I understand and the ones that I showed you here. So that workbook is the perfect example. Okay, someone said, can you hear it fine now? Great. Okay, good. That chart is a perfect example of basically what you're going to see happening seasonally every single year. This is wheat right here. A seasonal high in July or December, a seasonal low in June, August, and November. This is what you would need to understand. And so one of the things that you would be able to also have here for yourself is understanding this USDA agriculture report. Now, this is just if you were going to trade agriculture, like corn or wheat. There's different economic news announcements that you would have to keep in mind. And so this one is specifically for crop production. And I believe this one comes out on January 10th. So let's say, for example, I was trading corn or I was trading wheat or any of those underlines. Basically, I would be looking out for different product reports like this. And I actually have this in the course as well. We have a whole section on breaking down economic news, just like whether you're dealing with bonds, whether you're dealing with currencies, if you're trading gold, if you're trading oil, if you're trading any of that, we have different underlines that you probably want to keep in mind as far as economic news that comes out. And so this one in particular is with corn crop production reports. Let me see. And I'll also bring a Forex Factory as well. Now, this I would definitely use for trading God. Whenever you're trading the metals, if you're trading the energies, or if you're trading the currencies, you're always going to want to have your eyes on this report right here. So this is a calendar that I would definitely say to save, forexfactory.com. There's also dailyfx.com. They all have a different economics. Some of them have different reports. The two that I typically use are Forex Factory and DailyFX. And they'll show you different reports that are happening with different countries. Now, anyone who trades Forex, if you're an ex-Forex trader, you'll understand this and you'll see this and you'll be like, okay, yeah, that makes sense. Well, basically what you're doing is when you're taking this information and you're trading futures or futures options, what you will do, let's go to like Wednesday. Let's say, for example, it's Wednesday and we want to trade crude oil. Well, crude oil has an announcement at 10:30 every single Wednesday. So every single Wednesday, you can get your money right trading crude oil. Why? Because it basically follows this trend that you see right here. So let's go back in time. Let's look at January 3rd, 2020. Now, this is what the economic news is. The forecast was they expected negative 3.1 million barrels of crude oil. And the previous to that was negative 5.5 million barrels of crude oil. So what does this mean if there's actually negative 3.1? That means that prices are going to go up, and it has it right here. That's one good thing about Forex Factory is it tells you a little bit about it. So this is saying this is a US indicator, first of all. and it's the primary gauge of supply and demand in the market, which can lead to changes in production levels and price volatility. That's exactly what we see with crude oil. So this one said that even though it was negative 5.5 that they thought was going to happen, it was actually negative 11.5 million barrels. Not you can also mention the fact that this is not the only thing that would affect it, but also any fundamental news that's happening. So what's ever happening in Iraq or Iran, that's definitely going to affect the underlying as well. And so being that you saw this, right? A negative 11.5 million barrels. What do you think happened in that underlying? Anyone, what do you think happened? Do you think it went up? Do you think it went down? I see one person said Trump. Yeah, definitely. He affected it for sure. Price increase, right? Okay, well, look at this. /CL. This is what we saw. I'll bring this down to even a 15-minute chart so you can see the time period. Yeah. This was Thursday. And so you can see here, that was the announcement came out on the 5th. It already spiked on Thursday. This, of course, was probably due to Trump. But then also look at what happened on Friday. So this is what happened when the announcement came out. And every single Wednesday, this is what you can expect with crude oil. Whatever that announcement says, we're probably going to see a spike in the market, depending on the supply and demand, and if it actually is enough to affect it. So this is what we saw with crude oil. Now, the question is, how would you have been able to get in on this trade if you were trading options, for example? Well, after I see an announcement like that come out, and this is on Friday, let me ask you guys a question. How many of you guys get paid every Wednesday or on a weekly basis? Because again, this is a trade that you would have been able to take and you would have been able to get paid on a weekly basis. Here it is, /CL. This is options trading. This is the beauty of it. Okay, you get paid on Friday. Yeah, I'm showing you that this is literally every single Wednesday. Adding this to your portfolio is definitely a winner. Now, why would you want to trade some of these futures underlyings instead of maybe, venturing off and going into palladium and platinum? Because if you know anything about options, you know that there's a lot of different underlyings that you can trade. I'll show you guys the CME group where you'll see all of the different products. The reason why we stick to only trading God, those three right there, is because you're looking for volatility and you're looking for liquidity. So you want an underlying that has high volatility and you want an underlying that has high liquidity as well. This is it right here. This is crude oil. This is what you have that's called an options chain. And so this right here would be a 5-day expiration. Now, what are some of the pieces of options that I'm going to tell you about here, just so you can understand, because the market's open and I wanted to shoot this right when the market was open as well. So if I have 5 days, this is basically telling me that in an options contract, 5-day expiration, I have to choose a strike price. And so this strike price is basically saying where I think price will either go above or go below. If I'm doing a long call and I choose the strike price, let's say of 64, a long call, and price right now is at 63.79. Basically what I'm saying is I want to pay $1 per contract, and this is really times 100, but I want to pay $1 per contract to say that crude oil will be above 64 in the next 5 days, within the next 5 days. Those are basically all of the components of it. I'm going to write it right here so you see it again. I believe that this underlying will go above or below this price in a set number of days. That's basically one of the keys to understand. I just wrote it in the chat. So crude oil in this case, if the strike price is 64, I'm saying, okay, I think that it's going to go above 64. Now, here's the thing. I already think that crude oil has done its due diligence and gone all the way from 61 to 64. So do I think that it's going to continue going up? That's when I run over to understanding some of the technical analysis as well. So this is a daily chart, and this is showing me what you usually see with crude oil on a daily perspective. I like to look on the longer term perspective and then shorten it down when I'm looking for an entry. So I already think that crude oil is way overbought. It's about to approach that second standard deviation. And every time that crude oil touches that second standard deviation, probably only this time it didn't happen and it didn't go that far, it always tends to drop. And so for that reason, I'm probably going to be on the selling side. But I'm going to also wait and see what happens on Wednesday and what the news says. However, being that I see that it's already up here, I have a feeling that there's going to be some selling because the price has already passed this second standard deviation, and this is on a 4-hour chart. Well, the last time it did that, look at what happened. It went down all the way down to this standard deviation. Now, if you're looking at this for the first time and you're thinking, okay, what does that mean though? Just to give you an idea, crude oil moves at $10 a tick. And so every tick, every box that you see here, wait 1 second. Okay. Wait, let me see. Okay, this is crude oil right here. So basically every cent move that you see in crude oil, it moves at $1 a tick. $10 a tick. So you see it's at 630.70 right now. So every cent that it's moving, every tick, that's about $10. So when you look at a movement like this, I'm showing you that every cent is $10. So this right here is from 66 to 64. Somebody type in there how much you could have made. 66 to 64, $10 a tick, and it's $10 a cent. I'll let my mathematicians let me know what that is. What was crude oil under on Forex Factory? Well, what you're looking at is, let me show it to you again.
It's $10 per contract. You can buy how many contracts you like.
Let me see. I think you're looking at Forex Factory right now. So right here, you see crude oil inventories. It usually, I think last week it was on a Friday because of the new year, but every Wednesday it's typically going to be on a Wednesday unless it's a holiday that affects it. But again, this is something that you don't even have to get from Forex Factory. For the actual source, you can see that Energy Information Administration. So to trade crude oil, these are the numbers that you're looking at every single week. They see it right here. It says the next release is going to be on January 15th, 2020. The same thing's going to happen again. I could even go back in time to, and the thing about it is that when you're looking at these numbers, you want to make sure it's also significant. So let's say, for example, we go back to December 18th to do a little bit of testing on our strategy. The forecast is negative 1.5. The actual was negative 1.1. They thought it was actually going to go up, and it was going to be 0.8. So what is the effect of this? Negative 1.5, and the actual ended up being right around there, negative 1.1, even though the previous was way more than expected. Okay, let's look at it here. Going back to December, what day was that again? That was December 18th. Okay. So if we look on a daily chart, looking for December 18th, that's what we have right around here. So let's bring this down to maybe a 30-minute chart. Let's go back in time, even though we call this back to the futures. Okay, so that was right around here. So again, I don't want to bring it down to a 4-hour chart because it gets rid of the numbers, but you can see that it wasn't really a significant move. Like right around 416, we saw a little movement. I mean, it seems like it probably went up a bit. It just spiked up a bit from 60.20 to 61, but not as significant as what we saw on, January 3rd. And it's because the numbers were pretty close. They weren't that far apart. You're covering economic. Yeah, I would say that I'm looking at economic fundamental data for sure. And I'm backing it up with the technicals that you're seeing right here. So not only am I looking at economic fundamentals, but at the same time, I'm looking at these candles and I'm saying, okay, if I see that there was a good announcement with crude oil, meaning that maybe there was less barrels than expected. And so because of that, prices going up because there were less barrels, less demand. When there's less, there's a higher demand, so prices are going to go up. Kind of do that little seesaw in your head. So if that was the case, and then I also see that it's on a -1 standard deviation, then I may want to take that trade because not only are the fundamentals saying that it's going to go up, but then I also have the technicals as well that's backing it up in that case. So that's one of the reasons why I would look at doing one of those trades. Now, for example, what's happening with crude oil right now, where it's like at a second standard deviation, am I going bullish? I don't think so. I'm definitely going to be on the counter trend side because it's already at a second standard deviation. And looking at a 4-hour chart, I mean, every other time that it did that, this is what we saw. So I wouldn't be surprised. I'm not saying that they're doing some time traveling here and they picking the announcements based off of this, but all I'm saying is I wouldn't be surprised if on Wednesday crude oil has a super amount of barrels and then all of a sudden you see this dropping. Like, I wouldn't be surprised. Listen, you also have to remember this is the government you're dealing with here. So anything can happen. This is really their game. But what you're understanding here with futures, now here's the thing. I'm showing you a lot of different futures underlyings. If I were to show you stocks, the reason why I talk about less predictability in those cases is because you see a lot of different movement with these different underlyings. They don't always follow exactly what you're looking at. They don't always follow the trend lines. So this is like Tesla. Let me see, Apple. Wait. Okay, I don't know if you can still see this. I'm having a little bit of issues with the chart. Let me see. Yeah, with a lot of the different futures underlines, basically what you see is a higher predictability trend because you have this economic news data that you can use. And then you also have the fact that you have these trend lines, for example, that you can look at as well to understand when to get in. So trading gold, oil. I showed you oil. Let me show you the dollars as well. That's kind of what I had up here as far as these 6 charts. So these are 6 trades that I'm looking at right now, and it's based off of looking at these trend lines and then backing it up with the fundamentals. So right now, this is gold, and this is the Aussie. This is a Canadian dollar. This is, let me change this back to ZB. This is wheat and this is corn. And so even with the Australian dollar, this is a trade that I've been looking at now that I'm probably going to get in now since the market is open. But I've been watching this one for a while because this is what we've seen with the Aussie for the last basically year. It stayed between the first and second standard deviation. Now the reason as to why it spiked, I can't completely say, but I do know one thing: the fires that we're seeing that's happening in Australia, and it's so crazy what's happening there. My condolences to anyone who has family there. It's really like, I think it's like 124 acres that it said that has been spreading like at a crazy rate. But with the Aussie, basically, since we've been seeing that happening over there, I would be expecting a downtrend, not only for that reason, but also the reason as to why it jumped off of the second standard deviation. So being the fact that we saw this rally, I have a bearish position probably until the +1 standard deviation. I would say that I'm taking a bearish trade. Now, the only thing with the currencies is that you won't be able to get into these currency trades with options. So this would have to be an actual futures trade, at least with the on Thinkorswim. So with the Aussie and with the euro, I think, yeah, the same thing there. And with the Canadian dollar, you'll have to do futures. That's with the dollar, but let me show you, let me go back to gold. So gold, for example, a seasonal trade that you would see with gold is, let's say, for example, we'll look at the Christmas season. Why did gold do what it did from December 16th all the way up to December 30th? Just zooming in on this part right here. Well, most people would say, okay, well, maybe what is it, because of the holidays? Bingo, that's exactly what happened. Because of the Christmas holidays, because of the season overall, this is basically what we would see with gold. We would see a bullish trend. This is a seasonality trend that happens every single year. When you bring it out to a weekly chart, we see the same thing with gold. Why is this happening? A lot of people are buying jewelry, either in Asia and India. A lot of those places during this time, because of the holiday season, there's a high demand for gold. And so you see this happen every year. Coming back to 2018, look at this. There was a bullish trend with gold. Again, because of what we saw with the underlying, because of what's happening amongst people. Everyone wants to buy gold during that time for either the holidays, with, you know, whether or not we're having a major export to India and Asia as well, because those are two countries that buy gold a lot during that time. These are the seasonal trends that we're talking about. So when you ask what's the formula for taking profit and the percentage of it do you pocket, I would say anywhere between 25 to 50%. So if I were to look at a trade like this on gold, and because it already rallied up like this, I mean, I'm not really going to get into this trade because I haven't seen a significant level on it right now. It's still basically at the median. This is what we would call the mean. This is where price always tries to come back to. But I will say that so far we've seen a bullish trend in it. Will it continue to rally up? I'm not too sure. This is a daily chart, and it seems like it could continue going up or it could go down a bit. Gold isn't really one that I'm getting in right now, but if it was back in December, I would have definitely got into this. And the reason being is because I know the fundamentals behind it. I know that because of Christmas season, because this is the season of gold, it usually goes up during December. So hopefully that answers your question. Stocks depend on different variables based on companies. Exactly. They're periodic, and that's the reason why they shouldn't be treated the same. And when you're trading, that's the thing, though. There's been a lot of different underlyings. I don't know if many of you guys know Roku, but I know a lot of people who traded Roku. And what happened? They got into that trade, and the economic news could have been horrible. It still spiked up, and you're wondering, like, why? Well, that has to deal with high frequency traders. That has to deal with them holding prices, especially at the beginning of the market. You don't really find that with futures, as far as you don't see those spike ups, and they're not really, like, you can't trace them. Usually you can kind of trace it down to either a standard deviation level or you can run to the fundamentals and see what's happening also geopolitically or whatever it may be. And yeah, someone mentioned the fact that Valentine's Day is next. So do you see that trend happen at Valentine's Day? I'm not sure that the overall market of gold is heavily affected by it, because we're not only dealing with the US, we're also dealing with countries that we import and export from. So I can't say that that would be like a very strong trend, but it is something that you may see a spike around February time because of that. Definitely, this is what we saw in December, though. I mean, prices, you bring it down to a 30-minute chart, and just understanding that beforehand, what could you have done? Well, in the beginning of December, if I saw a 30-minute chart like this, let's see if it will pull up. Okay, if I saw a 30-minute chart like this, and whoa, it just, yeah, it shot up even more. This is Friday. So this is actually today, and this is what it did. It went from like 1550 to 1590. Yeah, the market just opened with gold. Wow. Wait 1 second, because I actually have some live trades going on, y'all, as well. So I got to make sure, keep my eye on that as well. Yeah, okay, so we have gold that spiked up from 1550 to 1590. Oh, man. So one thing that you'll probably see with a lot of futures underlines is the fact that they're all, some of them are tied together. So like what happens with corn, you kind of see it happen with wheat as well, and with crude oil. So when you're looking at, for example, gold, usually when gold goes up, the euro goes up as well. And I mean, it was a little spike. It went from 112 to 121. It's a little spike. Okay. Just want to make sure that's good. Okay, but yeah, with gold, you can basically look at seasonal trends, and you'd have been able to get in on this trade in early December. Even when you go over here to the trade sector, this options chain, I have a whole section in our webinar on our course where we talk about this options chain right here. How can you get in on these trades based on different expirations? So if you were doing a December expiration, for example, you'd be able to look at this, see how many days that you have left, and you're focused on the ask section right here. This is a long call. This is a long put. This is me saying I believe that crude oil is going to go down. This is me saying I believe crude oil is going to go up. Or since we were just talking about gold, that's /GC. Then I would look at this one. I would look at gold and I would look at their options chain. I believe their options chain has less expirations. I wish they had weeklies. That's a whole nother conversation. Weeklies basically talks about options contracts that expire on a weekly basis. They have a few here. But yeah, if it was a December contract and I had 19 days, let's say this is it right here, I'd see these underlyings, look at these strike prices, and I can choose my trade based on this. Now, what's something cool that you can do with options trading that I mentioned before that you can't necessarily do with stocks or futures or any of those? The logic that you can do, let me show you all. Okay, 14. Basically what you can do if you were doing a spread, let's go back to gold. So gold just spiked up, and right now it's at 1571. I'm looking at a 5-minute chart so I can see exactly what's happening. So let's say, for example, I want to do a bullish position on gold because I see on let's look at the 4-hour chart. 4-hour chart, it went past the second standard deviation. Okay, this one, it's still dancing. Again, it's not a strong trade to me because it's not like it's on the second standard deviation like the Aussie, which we will go back to. But if I was trading gold right now and it's at 1572, I can go over here, choose maybe the 5-day expiration. And let's say, for example, I'm going to do a short call, which is a bearish position, and I'm going to do a long call to back it up. So that's what we call a spread. And it's a credit spread because I'm collecting premium now. I'm going to do a short option. and I'm going to back it up with my long. So this would say, okay, I believe it's going to go down. Let's say a short call below 1575. I would click this one right here, go down to here. Let's click that again. Okay, I click that, and this is going to be my, well, no, this is the ask. We're going to click this one. This is a short call. So short call is going to be under bid, and ask is going to be maybe one contract, so I can show you how it looks. When I bring this up, it's basically telling me here, all right, so this is a good question that I know a lot of people have been wondering. How much money do you need? Okay, I see right here. What's the capital that you need to start trading options? Okay, this is going to answer the question for you right here.